G'day and welcome to this week's podcast, the Investor Motivation Podcast. Welcome, Rach. How are you going?
I'm well, thanks, Rob. How are you?
Yeah, going very well. What's news in financial world for you?
Very busy, end of financial year, of course. So, leading into that, cannot believe it is 30th of May.
Cool. We're about to roll over into winter and 1st of June. So This is end of financial year, and today's topic is
end of financial year planning.
Big surprise. So
exactly.
What we're going to do, we're going to go through, and so we will not bore you to tears on this stuff, but we'll just go through what we're thinking about when we catch up with clients, what we're trying to communicate to them to make sure that they don't miss out.
That's right.
And I think it's worth revisiting that these types of presentations often turn into a real discussion about superannuation. So let's kick off there, Rach, and let's consider why superannuation. Why does all financial advisors talk about superannuation? Why does your accountant talk about superannuation?
Yeah, mainly about tax, to reduce taxes in the structure of it. And we'll talk about the different types of contributions and why it is attractive. The tax results on the end game when you're in pension phase as well.
So why super?
Reduce tax this time of year.
Reduce tax compared to what?
So we'll talk about, I guess, the concessional contributions, why we're encouraging of people to make that. So when they're called concessional, it's because you get a concessional rate on the contributions.
Yes.
So when you put that into superannuation, it's taxed at 15% instead of your marginal tax rate.
Right.
So that's very attractive for those that want to reduce tax and also bolster their retirement funds as well.
So 15% in for those that are earning under $250,000 per year, and obviously 15% is very attractive compared to the top marginal tax rate of 47%, which kicks in once you earn over $190,000, and there is an extra tax, which is the Div 293 tax, where you do pay an extra 15% if you earn over 250 grand per year.
Yeah.
So it's that's where obviously there's an extra tax, but for the average Aussie that earns between, say, 45 grand and $135,000, they're going to pay 32 cents on the dollar. So they're saving a guaranteed 17% by putting some extra money into super.
Yeah, that's right. And that's, when it becomes, more attractive. Obviously, the more income you get, the higher tax rate, the more you get out of it.
Yeah, so. Fantastic. And obviously, that's leading up to retirement. And when does it become more appropriate to max out your superannuation, when people are juggling home loans and life and trying to have some fun now? When does it become more important? I
think as your balance sheet improves and you get access sooner. So one thing with superannuation is it is preserved until you meet a condition of release. So for me, at my age, for my example, I use superannuation to reduce tax, but I also don't ignore the fact that I want to enjoy life now and I want access to funds when I need it as well. So it is definitely a balancing act on everyone's situation and where they're at.
Right, and obviously the closer you get to preservation age, which is age 60, it gets obviously a darn sight more attractive.
It does,
to go down that path.
Yeah.
And as you said, it's a balancing act between the present, having fun now, and also not ignoring our future selves.
That's right. Cool. Yeah.
So why is it attractive when we actually do get to age 60, your preservation age, and then meet a condition of release and retire? Why is it attractive in retirement?
Yeah, so when in pension phase, you can have up to $2 million as of 1st of July, totally tax-free while you're over age 60 and in pension phase. So that's the earnings within the fund as well as on the way out. So, you can't get any better tax rate than 0%.
And obviously these are loaded questions quite often, but is that per household, for a couple or an individual?
Individual. So as a couple, $4 million tax-free. Pretty generous.
It is pretty generous, as negative as some people can be on superannuation, it's exceedingly generous. It's incredible. Fantastic. Very good. Well said. So I think we should now probably go through and say, well, what type of contributions can we put in? We spoke about the concessional ones where you pay 15%. So let's talk about those a bit more.
Yes,
and how much that is each year, and these strange things called carry forward. Is that the terminology that we're after?
Yeah, I think so.
Yep.
First, I guess we'll touch on so the cap is $30,000
Yes.
Per financial year. Now, it's important to remember that's also your employer contributions it's made up of, if you're salary sacrificing.
Yes. Yep.
And then also anything that you put in as, say, a lump sum. So it's made up of a few different things, that $30,000. When you speak of these catch-up contributions.
Yes. Yep.
So, if you haven't used in the previous 5 years that full amount of the cap at the time, then you can potentially put in an additional lump sum as well.
Okay.
Catching up from unused concessional contributions.
In the previous 5 years.
Yeah.
And to be eligible to use that, your super fund at the end of the previous financial year needs to be below $500,000.
That's right, yeah.
And it's amazing, a lot of people I've been chatting to of late, they're on top of this. They are using it. They're not letting it away. So it's use it or lose it.
That's right, yeah.
And if you're close to that 500,000 mark where you're not eligible, that if you use the catch up and that's going to take you over, that's where you might just do more.
Yeah.
For that financial year.
Yeah, that's right.
Yeah. Now, you mentioned salary sacrifice and you mentioned a lump sum. What's the difference there, Rach? And why should you choose one over the other?
Yeah, so salary sacrifice, that's one where you instruct your employer to put it into your superannuation account. So it's automated. There's no paperwork involved with it. It just happens for you. So if you know what your cash flow is and, you know what you can afford, then that is a great preference for us. If you get close to the end of financial year and you've got surplus funds available, you can still pop it into super as the lump sum.
Yep.
It does involve a bit of paperwork, so it's not automated, but it's still a great thing to do, or way to do it.
Right, so the paperwork, what's that, Rach?
Yeah, so some people get caught out, so they'll do a lump sum into their superannuation accounts with the intention of it being a concessional contribution, but they skip the second part of lodging what's called a notice of intent to claim form.
Yep.
That needs to be lodged with the superannuation fund prior to a tax return. So that's telling the ATO that you do want to claim the tax deduction.
Yep. So
otherwise it won't be included.
Cool. And I think the process there is you get your intent to claim form in to your superannuation fund. That is you saying, I want to claim that $10,000. It might take you up to $30,000 for the year. I want to claim that as a concessional contribution.
Yep.
They'll take the 15% out. They will send some type of acknowledgement, and you need that acknowledgement before your tax return is lodged.
That's right, yeah.
Fantastic. So this is where we probably prefer for employees, salary sacrifice is the way to go. Yep. You don't need to remember to do the lump sum. You don't need to remember to do the intent to claim form. It just happens.
Correct, yeah.
Perfect. Fantastic. Very good. So we've done the concessionals, we've done the catch-ups for those that have under $500,000 and haven't used them all. So we've done the carry forward. Excellent. Let's have a look at these other ones called non-concessionals.
Yeah. So these are the ones that you use your own funds after tax, so your after-tax money to pop into superannuation.
Right.
So the benefit is you don't get the tax deduction with these types of contributions, but it's allowing you to get lump sums in and build your balance over time.
Right.
Now, there are caps involved, of course. So each financial year you can put in $120,000, so using after-tax money. And then, again, you can get extra money in using what they call a bring-forward rule.
Yes.
So that allows you to essentially bring forward 2 years of that 120 plus the current year. So you can get 360 in one go.
Cool. So if we were thinking quite strategically, if I can pronounce my words nicely, we're about to go into June, we could put in $120,000 this financial year.
Yeah.
And then in July, we're in a new financial year. We could put in another 360.
Yeah.
So $480,000, remember, per person.
That's right.
Yep,
Yeah.
within 2 months.
Yeah. Yeah.
Yep, fantastic. Why would we do that?
Well, bolster your retirement funds, and again, get more into that environment where eventually in pension phase it'll be tax free.
Yes. Yep.
So that's the one thing that really highlights why we do that. I think it's the tax free side of it. Plus, it's invested.
Yes, yeah, of course. It goes into superannuation, and then we choose where it's invested, and that's probably that's a whole different podcast as usual. But using big non-concessionals like that, we're often dealing with people that have sold their business, sold their farm. There's been a transaction, and they are close to retirement.
Yes.
So might we do that for a 40-year-old? Possibly not.
Yeah.
It's 20 years before they can access that money. So it would not be just a
high on the list of things,
just a superannuation strategy only. There's tax reasons why you do that, but it depends on it was only a few years ago where people were getting 0.4% on their term deposits.
That's right.
It wasn't causing a tax problem. Now they're getting, and it's come down a bit, that 4 to 5% on their term deposits. When there's a lot of money outside of super, and they're closer to preservation age, that's when it's more attractive to get it in.
Yes.
Yeah. Fantastic. So we've covered off on the timing. We won't bore people with that. Obviously, when people are getting close to their total super balance, where they're getting up to that $1.9 million or $2 million from the 1st of July, that's when you can no longer put in non-concessional contributions. Now, non-concessional contributions helps us with a strategy called recontribution strategy, where we are reducing the taxable component of people's funds.
Yeah.
Yep. So this is where, and you can do all of this all the way up to age 74. So the taxable components of the funds is if your money is to be paid to non-financial dependents, so your adult children, they're not financially dependent on you, and if it's paid directly to the kids, then there is a 17% tax applicable on that money.
Yep.
So to a husband and wife, to spouses, it's not an issue, so don't panic there at all. It goes tax-free to each other, but to non-financial dependents, 17% tax. So the recontribution strategy is all about reducing the taxable and converting it back to tax-free. Please seek advice on that.
Yes.
Yeah. Very good. So you used to have to meet the work test once you were above 65. That then changed to 67 when the age pension rate age went up. But now for non-concessionals, you can do that all the way up to age. You can still contribute in a year that you're age 74. But the concessionals that Rach spoke about at the start, you do need to meet the work test after age 67.
67, yeah.
Whew. Did I get that right, or did I stuff up at some stage?
That's all good.
Terrific. Rach, let's get down to some of the other contributions, the easy win stuff, the low-hanging fruit that we refer to.
Yeah, so there's the government CoContribution. So that's designed to, for low-income earners, for the government to reward them essentially for contributing to their superannuation.
Yep.
Now, the lower threshold currently is if you earn under $45,000. Mm-hmm. If you put in yourself $1,000 into your super fund, the government will put in $500 into your super fund to reward you.
$500.
Yeah, so 50% return on your $1,000. So
fantastic.
It does reduce as your income goes up, and it does have a level that it cuts out on as well.
Yep, and that's up to a bit over $60,000.
Yeah.
Fantastic.
Yeah.
So who's obviously people with low income? So people that are students at a uni.
Yeah.
Fantastic. May not have the free $1,000 laying around to do that. But might their parents or grandparents be able to chip in?
Well, they may be.
Yeah.
Another where I see it come into play a lot with clients is if mum's taken up time for work, she's gone back part-time,
yes,
had a baby, her income's gone down, but they've still got cash flow coming in to be able to put that $1,000 into her superannuation
Yes.
and benefit from that.
Fantastic. So co-contributions, and it's been around for probably 2 decades now.
Yeah.
It's a real attractive one. So I think that's obviously grandparents and parents is. I think that's instead of material things that the kids may not need, because most people have things at everything they need. Perhaps it's one they don't need to. You can top up their super, and that will turn into tens of thousands of dollars down the track.
That's right. Yeah.
Spouse contributions. No one ever talks about spouse contributions.
No, they don't. So say we've got the husband and wife scenario. I'll pick on the wife again. She's working part-time.
Yep.
So if her income is under $37,000, the husband could potentially put $3,000 into her superannuation account.
Yep.
And then that will actually give him a tax saving of $540 on his tax return.
So it's a tax offset. It's not a contribution to the super?
No. Yeah.
Fantastic.
So essentially that works out on the full $3,000, about 18% return on it.
Rach, do you want to just briefly touch on the downsizer? We're not seeing it used substantially at the moment, but it is an option there when people sell a home over age 55 and downsize.
Yes. So, you can use the downsizer contribution. So if you've exhausted all your other contribution limits, sell your home, you've owned it for more than 10 years is one of the things. You can put in $300,000 each as an individual into your superannuation accounts. So it's got to be done within 90 days of settlements. There's all kind of things, but it's a good strategy, to bolster up again your super balances in preparation for your retirement.
Good. And there's actually no age limit on that one. You can be any age and still get some money into superannuation.
Yes, yeah.
Fantastic. Now here's one. I mentioned the spouse contribution doesn't get spoken about much or at all, but we speak a fair bit about super splitting, but I just don't hear it out there. This is where you put in your super contributions, your employer contributions, and you can split that up to your spouse, either older or younger. You might do older to give earlier access, or you might split down to your younger spouse to get things ready and eligibility for Centrelink, perhaps.
Yeah, that's right. So it's 85% of your concessional contribution you can split to your spouse. Some people also use it to equalise the balances of their super fund. So if the wife, again, scenario, but if the wife hasn't been working in acknowledgement of looking after the children, her balance isn't quite as high, so they may look to equalise it out a little bit.
Yeah, and I think the way that we've spoken about and used it, Rach, has been, large age gaps between spouses, and the younger person, got the higher taxable income. We're splitting that concessional contributions up to the older person, so they've got earlier access, because we're acknowledging that, given there's often a decent age difference, that there's going to have to be some give and take in terms of holidays and work. You can't just, the older person just can't sit at home for 10 years waiting for a career to finish.
That's right.
And by the time that happens, they're too old to do anything. Yeah. So splitting money up provides some of that firepower to go and do the stuff they need to do.
That's right, yeah.
Fantastic. Very good. I don't think we'll delve too deeply into self-managed super funds and the new rules and the $3 million ones.
Not today.
Not today. We're working really, really hard with a lot of our clients where there is a lot of farming land that's caused a lot of problems. A lot of money is over those numbers pretty comfortably, and that's because farming land locally here has gone through the roof. But for those that have a self-managed super fund and currently receive a pension, that you do need to check.
Yes, that's right. Making sure that you're meeting those minimum requirements. Based on your age and the balance.
Fantastic. So that's something we do in May and June of each year. And that just gets done for our clients. But if you look after your own super fund, make sure you're checking that out. It is worth looking and reviewing your superannuation estate planning. So essentially what we're talking about there is your super binding death nominations. and have a binding death nomination that doesn't lapse, and that will help making sure that your money gets to the people you want it to get to. Cool.
Yeah.
Anything else, Rach?
No, I think that's it for today.
Done.
I've given you all a lot of information and things to think about.
Yeah,
so.
in a short fire chat. So
Yeah.
well done. Thanks, Rach. Where can people find you?
Yeah, so Rach Todman on Instagram or TikTok.
Yep.
Yeah.
And Rob Goudie on TikTok and also Instagram, and of course our YouTube channel Invest Motivation it's been our labour of love for well over a decade. So there's 750 plus videos there. Thanks, Rach. Thanks for
Rob.
everyone for listening and tuning in. Cheers.